So hello everyone. So welcome to this class. Our main subject today is going to be financial planning. But before we get to financial planning, I'd like to finish that little portion which we did not cover in the last class. Now, if you remember, we were speaking about capital budgeting. Prior to that, we were also speaking about corporate objectives and strategy. Now, in that connection, I'd like to speak to you a little about the dividend policy which is adopted by a company. Now, the dividend policy which is adopted, that is something which has a lot of impact on the, let's say, the share price of the company. And just give me a moment. Just a moment for me to share the screen. Okay, here we are. So talking about dividends, let's just get the basics out of the way first. So what is a dividend? So basically, a dividend is the cash payout made by a company from its profits to its investors. And this is done from the profit earned by the company in that year. Now, a dividend can only be paid from profit. Now, the proportion of the profit that is to be distributed, whether you distribute 50% of the profit, whether you distribute all the profit, this is something which depends entirely on the company itself. The board of the company will basically decide this. Now, is dividend relevant? See, if dividend is not given, then that money which is not distributed, that will remain with the company. And presumably, the company will use that to grow more. So one way or the other, the shareholder will get some benefit out of that profit which has been earned. One benefit is direct, where the dividend is given to him. It comes into his bank account and he can use it in any way he likes. Or alternatively, even if it is left with the company, if the company grows, becomes more powerful, its sales increase, then in that case, once again, its share price is likely to improve, and that will lead to an increase in the value of the shares held by the investor. So in any case, the investor is going to actually gain. One is directly, the other is indirectly in the future. Now, there is this whole theory about this. It's called the dividend irrelevance theory, and which basically says that it's not relevant at all. You give people dividend, you don't give them dividend, it really doesn't matter. See, if you don't give dividend and the investor really wants to, he's in need of money, he can just sell a few of his shares and get that money. So it's not such a big deal. And market behavior shows that dividend payouts minimally affect share price. So there's a very little impact on share price if we look at the stock market. But dividend paid is income for shareholders, and the biggest shareholders are the owners of the company. See, this is the relevant thing. Most of the shares of a company, in some cases, very, very high percentages of the shares, maybe even 50% of the shares or more, are in the hands of the people who started the company. And for them, that dividend is the reason why they started it. See, they want to get back something from the huge investments that they've made. Therefore, for these people, it is necessary that a dividend be declared. So for them, it's definitely important. Now, most companies, they view this dividend policy as an integral part of their corporate strategy. Now, the amount of dividend which is to be given, the timing of the dividend, all that is going to be decided by the management. So that's one basic thing about that. Now, as we've just said, the dividend decision basically balances the shareholders' desire for dividends and the need for growth. Why is there this whole thing about growth coming in? Because the money that we give to a shareholder, if we did not give this money and this money remained with the company, then it would be very easy for the company to use this money to grow the company more. To invest in maybe a new factory, a new machine, buy some land, do something with it, do something constructive. In the case of an R&D oriented company, it could use it for more research. So it has many things. And whatever it does with that money, if it takes the right decisions, the chances are that in the future, that is going to be of great help to the company and will lead to an increase in their revenues and ultimately an increase in share values. So that's one aspect. The other aspect is the shareholders, what is the return that they actually get? So one part is dividends and the other part is capital gains. Now, what is capital gains here? Capital gains is the amount by which the share price increases. Now, dividend policy is going to have an effect on both. It's going to have an effect on the return, the dividend itself, and it's going to have an impact on the capital gains itself. We'll see a few slides down exactly how it impacts the share price. Now, the growth that a company has, there is a simple, this formula is there. Growth is equal to the return on equity multiplied by the retention ratio. Now, to explain this, what is the return on equity? You take the profit after tax and you divide this by the shareholders' funds. So the equity, the amount which the shareholders, the original promoters and the other shareholders who invested in the company, the total amount which they have if it's 20%, then whatever is the retention ratio, if we take that, what can the retention ratio be? The most it can be is 100%. The least it can be is 0%. You don't give any dividends. That means you're retaining nothing. Or if you don't give any dividends, the dividend is 0. Your retention ratio basically is 100. On the other hand, if your retention ratio is 0, that means you're keeping nothing. Then that means you're giving 100% as dividends. Now, if you retain more in the company, let's say you retain 100% and your return on equity is 20, then the chances are that all this, when it is going to be, if it earns the same return as equity was earning earlier on, it will mean that your growth is going to be an additional 20%. Because the return on equity is 20%. So a low payout policy might produce a higher share price. How does this come? If I retain less, then I have what is known as a high payout policy. But if I retain more, I pay out less. So basically, it's a trade-off between what I retain, and what I pay out. These are the two things which I'm basically looking at. So when I retain more, I pay out less. So in that case, if I have a low payout policy, basically means I'm retaining more. More of the money which has been earned by way of profit is going into growth. Now, this is generally picked up by the market, especially if that growth is significant, and it leads to a demand for the shares, and consequently leads to a higher share price. Because as more and more money is pumped into the business, this generally tends to accelerate growth. And that is what this particular little expression here is also trying to tell you. If the growth is going to be much more, if my retention ratio is higher, because whatever is the return on equity is going to be multiplied by this, by the amount I retain. Now, investors of growth companies will realize their growth mostly through capital gains resulting from appreciation in share value. So those investors who invest in companies which are known as growth companies, these companies are not interested in giving you very regular dividends. They want to grow their company, increase their sales, increase their revenues, increase their market share. And in the process, in the long run, what is going to happen is that they are going to end up with a much higher share price. Now, the flip side of the low payout policy is that capital gains occur in the distant future. At some point, when those shares are ultimately sold at a much higher price, the shareholder has to pay capital gains. But as long as the shareholder is making a good amount of money from the increase in share price, I don't think he'll really mind paying a share of it as taxes. Then there is that risk. If for some reason the market doesn't quite get the right signals, if the market feels that the company hasn't really done a good job of growing the company, or has grown in the wrong direction, has taken the wrong sorts of initiatives, then in that case, that demand for the shares may not pick up, in which case you will not have a high price of shares. But ultimately, when the management does it, they have faith in themselves and they do it. And there's always risk in business. So if a situation comes where they read the situation incorrectly, they are unable to, really make good money out of it, then that's too bad. That's something which you really can't do anything about it. Then here is an example taken from a standard book on dividends and basic financial management, in which we have a comparison. It's hypothetical, but it'll give you an idea, at least the theoretical idea of what should happen. So here in the first part of this particular page, you have a high payout company. That means it's giving a lot of dividends. And here we have a low payout company, which is giving very low dividends. Now, the first is the equity share price in year one. So let's say the first year, the equity share price is 100. Earnings are at 20%. Dividends are 16 rupees. Dividends are 16. That means profits were 20. Dividends were 16. Retained earnings are 4. Now this 4 is going to go back into the business. 16 rupees are given as dividends and 4 is going back into the business. The next year, the share price increases to 104. The earnings become 2080, because remember it's 20%. So 20% of 104 is 20 rupees 80 paise. As a result of this, when the dividends go up to 16.64 and the retained earnings become 4.16. 4.16 plus 16.64 gives me 2080. Now, if I take this 4.16 and add it to the 104, which was the share price in the beginning of the year, I get 108.16. So what we are seeing here is the share price keeps increasing. Assuming that the earning continues to be at 20%, this year's earnings will now be 21 rupees 63 paise, and the dividends are going to be 17.31, and retained earnings will now be 4.32. 4.32 plus 17.31 is 21.63. So what we are seeing here is that the retained earnings here are getting reflected in the share price. Now, as we go and we reach year 10 years after this company was in operation, we find that the share price has risen to 142. The same thing continues. Dividends continue to be given massively. Less is retained in the company, and share price increases are not very significant. Considering that 10 years have passed, from 100, this particular share has only grown to 142. So by any standards, you cannot say that this is particularly high. And then in year 20, it's reached 210.68. So capital appreciation, as far as the shareholder is concerned, it's not very significant. What did the shareholder actually get out of this? He got steady dividends every year. So this is, for a high payout company, this is basically what the shareholder got. This part here is not very significant. Now let's take another company. This company went for low payout. That means what it's doing is it's retaining most of the profit within the company. So look at this here. 100 is the share price, same as this. Earnings are 20 at 20%. 4 rupees is given as dividend. 4 by 20. 4 by 20 is what? 1/5. 1/5 is 20%. So 20% is retained, given as dividend. Payout is 20%, and 80% is basically retained. Now this 80% which is retained, this results in the next year share price going up to 116 as compared with 104 here. The next year on 116, the company earns more. It comes to 23.20 because more has been retained in the company. Therefore, with more money being plowed into the business and the company maintaining its profitability of 20%, the actual amount it earns is much more. So here it was 20.80, it's gone to 23.20. Then again, it does that 80-20 thing, and it sort of gives a 20% dividend. 80% is again plowed back into the company. And that results in the share price going up to 134.56. Now, this policy is followed year after year. By year 10, we can see that the share price has gone up to 380 rupees 30 paise. So there's a huge capital appreciation as for the investors here. And compare it with the position of the shares here in this particular year, in the 10th year for the high payout company, where it is 142.33. So what we see here is that we are actually in a position where this company, the low payout company, its shares are doing much, much better than the shares of this high payout company. Mainly because of the fact that it's taking the money it's earning, taking 80% of the profits, putting it back into the business and using that to earn more money. So logic of this particular low payout policy is that as my company begins to expand more, And see, the best part of this expansion is that it is expanding from its own resources. It's using its own profit to expand. It's not borrowing. Or if it's borrowing much less. It's using its own money. And that's always the best kind of money. And as a result of that, it's really doing well. And in the 20th year, if you take this model further, its share price has gone up to 1677.65 from 100. So just look at this. It's more than 16 times of growth as compared with this case, where it's just 2.1 times growth from the 100 to 210. So this is the logic behind retaining the profits in the company and not actually going for going for making huge dividends. This is the basic thing. Now, this is the same thing shown on a graph, but you'll find that much more helpful. And some of the things which a high payout policy means, I've tried to put this here for you just in case you don't grasp it intuitively from the table that we had earlier on. A high payout policy means more current dividends and less retained earnings. This may result in slower growth and perhaps lower market share per share. Dividends are current earnings and can be taxed at a higher rate than capital gains. So the shareholders who get these earnings, they will basically end up, let's say, paying a lot of taxes, because typically all of us who pay income tax, we know this, that the income tax rates for current income are always higher than the rates for capital gains. And it's a difficult decision for the company. Point I'm trying to make here is that this much money, which could have been used in the company, has to now go out as dividends. So since it's going out as dividends, if the company wants to expand, it will now look to other sources for getting the money. They'll basically have to borrow money, which is never an easy thing. See, if an investment is to be made from the profits by retaining profits at the cost of giving dividends, the dilemma is which to prefer. Ultimately, this is the point. If the company pays dividends, it may have to raise funds to make the investment. So if it needs to invest and it pays dividends, then it'll have to borrow money to make that investment. That's the basic point there. So there is a trade-off between retained earnings and issuing new shares. So that's one point. Now, here is an example of the capital structure and dividend of 6 companies. We have Britannia, Century Textiles, Asian Paints, Tata Motors, Marico. Marico is basically FMCG. So you can think in terms of parachute oils and all that, hair oils. Apollo. Apollo is Apollo Tires. So now look at this. The retention ratio for Britannia is 0. They give all the money out as dividends. They don't retain anything at all. That's because they're already so cash rich that they don't really need to do this. They've got their network in place. They don't have heavy capital investments involved. So they don't do it at all. Century, on the other hand, Century Mills, it is not paying dividends very regularly. So for the year I've taken this, their retention ratio is actually 100. They've retained all their profits and their dividend payout ratio is 0. So they haven't paid any dividends at all. So different companies, their needs are different. They adopt different policies. Asian Paints, very good company, doing fantastic work for the last 50, 60 years. They have they sort of walk a middle of the road policy. Retention ratio is 45. Dividend payout ratio is 55. So they keep the shareholders happy also. At the same time, they keep back enough money with themselves to invest in their company. Tata Motors, they've basically retained all their profits. See, Tata Motors is at a stage where they're expanding heavily into electric vehicles, and they need money for that. So instead of going out and borrowing, they already have fairly large borrowings. What they're doing is that they're taking whatever profits they have and they are retaining that. Now, you take Marico. Marico is paying out more. Once again, FMCG, it's a company which is making a lot of money. 87 is their payout ratio, 13 is being kept back. The other reason is that in the case of companies like Marico, it's not a very capital intensive company. They don't need so much of investment on capital goods. So because of that also, their needs are less, hence the dividends are more. Apollo Tyres, this is a company which is trying to increase its market share, coming out with new types of tires constantly. They have needs. They have to expand. Therefore, their retention ratio, you see, is 100. They have not given any dividends in this particular year, and they've retained this money with them. So what this tells you is that there is no fixed formula. Different boards of different companies, depending on their needs, they decide. As you know, these decisions are taken before the AGM, the annual general meeting of shareholders, and it's ratified there by the majority. But ultimately, it is a decision which is taken by the board of directors. So I'll basically stop this discussion on dividends here, and we'll now go to our next section, which is financial planning. Just a moment. Okay, here we are. Now, when we talk about financial planning, basically, this particular section is different from the pure finance topics that we've been looking at in the last few lectures. This one is more about individual financial planning, and the purpose here is to give you an overview of what products are available for you for your own financial planning, the risks which you face, and other related things. Everything here is basically designed to make you a better financial planner for yourself. So essentially, some of you see the age group here is, I have a fairly large, dispersion of ages. Now I've got people who are, some of you are, let's say, very young. You haven't started the income journey yet. There are many of you who are in the middle of that journey. There are some of you who are reaching the end of it. So this lecture is going to mean different things for different people. For some of you, it may actually be helpful. For other people, it may help you to compare what's said here with the approach that you are adopting. So what are we going to do here basically? We look first at what financial planning is, and it's simple enough. Is the practice of putting together a plan for your future, specifically around how you will manage your finances and prepare for all of the potential costs and issues that may arise. The process involves evaluating your current financial situation, identifying your goals, and then developing and implementing relevant recommendation. So nothing that you didn't know. Basically, it's about managing your finances, taking the right decisions. So what are the three basic pillars here of this whole definition? One is evaluate your current financial position, identify your goals, and make a plan to meet these goals. Next slide, I'm trying to cover this in more detail. So a plan for managing your financial resources so as to meet all your present and future needs. So you see, the basic idea is you have needs right now in the present, and then you have needs which are there in the future. So that you have to strike a balance. Your planning has to be such that it doesn't, make you sort of, you have no money in hand, you invested everything, which could be disastrous. So you have to look at all aspects here. Now, what are the steps here? First, determine your financial situation. Now, to do this, ideally, you should make a balance sheet. How will you make a balance sheet? Simple thing. To who do you owe money to? If you've taken loans, if there is anything at all that you've borrowed, write that on one side. And on the other side, you write about all the assets that you have. So you start with the liquid assets, things like cash, shares, mutual fund units, gold and jewelry, that sort of stuff. And then you move on to other assets, such as if you have a car, there's a car, there's a motorcycle, you have a flat, you can write about the flat. If you have your PF in your office, your provident fund, you write about that. Whatever other investments you've made, you write that. You take your LIC policies or any insurance company policies that you have, you take a note of that. And then you see exactly when these things are becoming due. The cash is liquid enough. The shares and mutual funds, all of that can be in cash. But if you have fixed deposits, have a look at when exactly this is going to be due. When will you get that money? Apart from that, you may have a public provident fund, apart from your regular provident fund, which the employer gives you. When will you get this money? Obviously, at the time of retirement, the PPF you're going to get after 15 years from the date you actually started it. So you look at these things and try to understand what money you have for the present and what money you have for the future. And then the next thing to do is assess your liquidity position. Then you look at your income. Look at the income you're making. Look at the amount you can actually save after meeting your basic day-to-day requirements. Once you've done that, you begin developing your financial goals. So you're going to have some short-term goals and you'll have some long-term goals. Like, for example, short-term goals could be, maybe you want to change your car, you need money for that. Maybe the education of children, you need money for that. There could be medical expenses involved. And in the near future, you could be looking at that part. So short-term goals, long-term goals obviously would be for another long-term goal for in respect of children could be education. In respect of yourself, it could be maybe to finance a house. It could be to your retirement plan, the biggest one of all. So for these, once you've got these goals, you try to put a figure to them. Each goal has to be spelled out in terms of money. How much money do you need for each of these goals? And then once you have that, you've got your goals, then you begin to think of what you can do to reach these goals. What are your available options? And then all the options that you have, for example, are you going to do this by opening a SIP with a mutual fund? Are you going to do this by opening a recurring deposit with a bank? Are you trying to do this with, having a trading account where you basically buy and sell shares, or try to build up a certain, portfolio of shares of different companies and then hope that the share prices will increase and get something out of that? What exactly are you trying to do here? So have a look at that part. Then you implement it. Once you know what risks are involved, you know exactly what you want to do, you implement the plan. And then every year at least, you begin reviewing the plan. Just make sure that everything is running as per the plan. If there are changes which you need to be made at this stage, you should go ahead and make those changes. Now, why do we need financial planning? Because we have limited amounts of money. And because we need to meet these short-term and long-term goals. So short-term, typically, car, flat, holiday, education of child, marriage of child would be the medium term, and then retirement. Manage your financial resources. So there are existing resources. What are these? All financial assets that we have: cash, stocks and shares, fixed deposits, land, residential property, commercial property, jewelry, gold, etc. You find out exactly what the value of each is. Write it down for yourself. Next, future financial resources. Expected income from your occupation. What will you get? What are you earning? What do you expect to get in the coming years? There could be some inheritances which you will get in due course. Keep it in mind so that you know exactly where you stand. Now, what are the elements, the different elements involved in my financial plan? One is, of course, tax planning. This is an immediate need. This is something which you have to do in any case because it's a mandatory, it's a legal requirement. You don't pay taxes, you're going to be in trouble. So you start here. Insurance planning. This is another part. Budgeting based on income. That's your day-to-day expenses. And the investment planning, you have education fund planning, you have your retirement planning, and remember one thing in retirement planning, retired life can be for 25 to 30 years. So the plan must be good enough to sustain a family without income for this period. So the corpus of money you're building up should earn enough interest for those 25 or 30 years that you have after retirement. Assuming that a person doesn't make any money in that period, and a time comes for everyone when you stop earning money. At that point of time, whatever money you had set aside, you are basically dependent on the interest income from this money. That is why it always makes good sense to be very cautious here and to try and make sure that that corpus that you build up is seriously large. Otherwise, with inflation and with the sort of demands that may come with the passing years, you don't know exactly what trouble you'll be in. Now, the retirement planning part also has this, an estate planning thing. That is making a will, making sure that those who will inherit your property don't face trouble when that day comes. And then there is, if you can afford it, there is philanthropic planning. If you have, you're socially, let's say, inclined and you want to help, then in that case, it's good to think about this also. So this part here, the philanthropic planning and the estate planning, this is based on wealth basically, and certainly not applicable to all. So that's one point. I'm giving you a small template here for a financial plan, so you have an idea about this. So first question to ask yourself is, do you have 6 months of emergency expenses? So ideally, this money, first you calculate the need, how much do you need? This amount of money should be readily available in your bank account. So that's the first thing. So start with saving in a bank till you have 6 months of expenses. That's number one. Do you have dependents? So if you have dependents, you do not need life insurance. You need term life insurance. So there's this term life insurance is a particular type of life insurance, which I'll explain to you when we come to the section on insurance. But basically, this will provide much better protection to these dependents if for some reason you stop earning. That is, if the insured person here, if he passes away and income stops, then in that case, a term life insurance typically provides much better protection for those who are dependent than a regular endowment policy in a life insurance. So I'm using two words there, which I will explain later on in this presentation. So get a term life insurance policy till the age of 60. The amount of policy should be 40 multiplied by annual expenses. That's just a thumb rule. You can always rework that. Then do you have health insurance? Get cover for your family. This is normally called a floater policy for at least rupees 5 lakhs. Now this 5 lakhs thing, this is a totally, it depends on how you work this out. It could be 5, it could be 10, depends on the sort of offers you get, the sort of premiums that you are in a position to pay. But the basic thumb rule here is that make sure that you have enough insurance. If you don't have enough insurance, this could actually be troublesome for you. Get a super top-up plan for health issues of greater than rupees 10 lakhs. So the whole idea is that it's better to pay premiums where you know exactly what you have to pay, rather than be faced with an eventuality where you're in hospital or some family member is in hospital and then you're suddenly saddled with the responsibility of paying huge bills. So it's always better to have more cover here than less. Now, where did I get all this? I'm giving you a reference. The book is Money Wise by Deepak Shenoy, published in 2021. If at all you guys are inclined, please buy this book, have a look at it. It'll help you a lot. Irrespective of age, there is a lot to learn from the book. I think Deepak Shenoy has put a lot of thought into it and expressed himself in a very, very good, clear, lucid style. So have a look at this. Now, continuing with this, if you have children, school expenses, so this is to be paid from your salary income. College expenses, typically you should be saving for this. You should be saving for this so that you have a corpus of income by the time your child turns 18. Now, it's like this. If there are more than 10 years for the child to turn 18, it is advisable that you do your savings in equity. Over a 10-year or more period, if you invest in good companies, don't be reckless here, the chances are that you will make a return which will be better than any bank, better than mutual funds. The thing about equity is that you end up earning a lot of money, provided you have the patience and provided you stay invested long enough. And I would say that 10 years or more is definitely long enough for you to get something. Now, if the period left is between 5 and 10 years before the child turns 18, then you reduce equity to 70, go for debt, 30%. If there are just 1 to 5 years left, then equity only 30%, debt 70%. Why only 30%? Because in such a short time, it's very possible that shares are volatile. You invest in year 1, and maybe by year 3 or 4, those shares really haven't made much money for you. And you could actually end up earning less than you would have had you gone for a more, let's say, conservative type of investment in a bank. If it's less than 1 year, then you don't even think about equity. Put all your money in debt. Your options now are very, very limited because debt is going to pay you 6, 7, 8%, not more than that. So other lesson to draw here is that if you have children, start saving early. Only then will they be assured of a good college education. Then you have this big question: how much do you need when you retire? Now, to estimate how much you need, there's this thumb rule: the number of years to retirement multiplied by annual expenses multiplied by 3. We won't get into the mechanics of the rule, but just do the calculation, do it honestly. You will end up with a corpus, a certain amount, and then it is for you to figure out where to invest the money so that you can get that amount by the time you retire. That retirement age, of course, is going to be different for each of us, depending on whether we are in a salaried job and there's a cutoff age, whether we are in business or whether we are a professional. So it depends on that. But whatever be the case, there will come a time when income will, in all probability, stop. And at that point of time, we need to have a steady income coming in from interest, dividends, and things like that. So if a 40-year-old has 20 years to retire, imagine that this person is retiring at the age of 60 and has annual expenses of rupees 12 lakhs. He will need 20 into 12 into 3, that is 4.32 crores. So the into 3 here is essentially looking at the inflation part. So 4.32 crores. At the age of 60, he has this money. It's very possible that if he's in reasonably good health, this money will basically be sufficient to take him across the next 20 years. By that time, his expenses will also have gone down. The other question is, do you have loans? Your insurance should cover your loans. Whatever insurance you have, those endowment policies you buy or whatever it is, those should be enough to cover your loans. If you're going to use your savings to pay off your loans before retirement, then I would not say that that is financially savvy. You're going to be in big trouble there. Okay, now the next thing here that we look at is, we look at your risk. We try to talk a little about risk profiling. So we'll take a 1-minute break here, and then I'll be back with that section. Okay. Now, this concept of risk profiling, this is something which is important because it will help you to sort of assess your self also. So imagine that you're a profiler, somebody who can assess risk. And let's approach this slide from the point of view of a profiler, somebody who wants to understand risk and how it affects an individual. So risk profile is the optimum level of investment risk an individual is required to take, considering the individual's risk capacity and risk tolerance. So the two words which we're introducing here is risk capacity and risk tolerance. The other thing which you may have noticed is, and I've highlighted that, emboldened it, is the word required. Now, required is put deliberately because anybody investing in any instrument will always be exposed to a certain risk, except for a very small category of low interest investments, like, for example, a government bond or let's say the fixed deposit of a very good bank. There is no such thing as a risk-free investment. There is always risk, and all investments which will give you a decent return will always come with a certain amount of risk attached to it. So there is a certain amount of risk that you're required to take always. Now, this depends on your risk capacity and your risk tolerance. So the capacity and tolerance are very, very important. So any investment goals requires that a certain amount of risk be taken, like I said. So if you want to have a return, you have to take a risk. If the required level of risk is not taken, it would lead to a lower return and the non-achievement of the objective. This is another very, very big point. So for example, let's say I'm trying to build up a retirement fund for myself, that huge corpus that I want for that period when I do not have any income. And if I'm not willing to take a certain amount of risk, and I want to stay very, very safe, and then I invest only in bank FDs, it's very possible that that 7 or 6% return that the bank gives you will actually not help to build up your savings to the level which is required for your retirement. That won't happen. And if that doesn't happen, then you will be terribly exposed to risk when in those days when you're old and you don't have sufficient income. So one thing is very clear: low risk, low return. And the return is lower than required. See, nothing wrong with low return had it been what you really wanted. If it was enough, it's okay. But if it's not enough, then there is trouble. High risk, high return. This is the other side. So if I want a high return, I have to take a high risk, but maybe I'm not prepared to take a high risk. Maybe I can't afford to take a high risk. I don't have the capacity to take a high risk. But what this means is that I have to plow the middle course here. Find a way of sort of having a reasonable level of risk and getting a reasonably good return. So high risk, if it is beyond your risk tolerance limit, it's gone. Then you can't really use that. So the level of risk required to be taken depends on risk capacity. What is this? Is the level of financial risk the client can afford to take. This will depend on the income and savings of the client together with his liability. So it's ultimately an amount. So if you have a certain amount of income, you have a high income, then you can take a little more risk in terms of money. Because since you have an income, and if you lose money, you can still make it up. But if you have a very low income, the amount of money that you can actually lose is significantly less than a person who has less income. The other side is your expenditure side also will influence this. If you have lots of expenses, more dependence, and less savings, then once again, you have to be a little careful with risking money. Risk tolerance is the level of risk that your client is comfortable with. I'm writing using the word client, thinking in terms of a profiler, but basically, if you're doing this for yourself, then you're the client. So the level of risk with which you are comfortable with. So this is a psychological characteristic and will differ from person to person depending on temperament. Some individuals can take more risk, while others are conservative and have a fear of risk. So, while teaching in college, I've always tried to poll my students to see what sort of temperament they have. So they're all in their 20s or late teens. And when I ask them this question, without fail, I find that you can take the class and very easily divide them between these two groups. Some of them who, maybe because of their age or maybe that's the way they are willing to take any amount of risk. And there's the other group, which even at this young age cannot imagine themselves taking, too much risk. They are more interested in getting a steady return. So that's the risk tolerance which a person has. The other point here is, what if there is a mismatch between the risk capacity and risk tolerance? See, ultimately, then you cannot go beyond your capacity. So I'm assuming that you have the capacity, but your risk tolerance is so low that you're not willing to risk even up to the level of your capacity. If that is the case, then you will have to look at this part again, that required level, which is, which you have, that required level of risk, which is needed for you to achieve your goals. And ultimately, you'll have to let that decide. You need to make a certain amount of money before to achieve that goal. And let's say you don't have the temperament to take too much of risk, but you have the capacity. Then you will have to sort of talk yourself into taking that risk, because if you don't do that, you're not going to achieve your goal. So let's just remember, ultimately, it's the goal and the capacity which is going to decide how much risk we actually take. Now, the other part here, which I'd like to discuss is, the different risks associated with investments. So let's take the first one, default risk. Now, I've been a banker most of my life, so I've been seeing default risk very, very closely. What is default risk? It's basically when somebody takes a loan from you, from a banker's point of view, somebody takes a loan from you and he doesn't repay the loan. That's in banking, that's called a default. Now, from your point of view as an individual, you deposit money with someone, let's say a company, and that company defaults in paying you either the dividend, the interest, or the capital. That is a default. So when, see, in finance, a financial instrument, any financial instrument that you buy, whether it's a fixed deposit, whether it's a mutual fund, a unit, whether it's an equity share, whether it's a government bond, the underlying basis is the financial commitment made by the person issuing the instrument. If you buy an equity share, there is a commitment by the company to use those funds with prudence and to give you a good return. When you buy a mutual fund, that same sort of prudent decision-making is expected from the fund manager. When you buy a fixed deposit, you expect the bank to keep your money safe, to use that money to fund the right types of borrowers, and then earn more than they've promised you and give you back a decent return. Your expectation is that whatever commitment is being made will be lived up to. So there is an element of trust. You're trusting these people with your money. So all financial investment begins with trust. That's the first thing here to remember. Now, the risk of the company in which funds have been invested performing badly and consequently being unable to repay the interest or even principal amount invested, this is something which can happen. This is something which can definitely happen. There are cases of companies, going under, and you're left high and dry with your, with a huge loss on your hands. So what can you do about this? Choose your companies, choose your investments with caution. That's one. Now, there's another type of risk, which is known as interest rate risk. When does this occur? This occurs when after an investment is made at a particular rate of interest. Let's say you invest at 7%. The general interest rate prevailing in the market rises. Let's say you get into an investment at 7% and you're locked in for a period of 3 years. You can't come out. Let's say it's a fund which ELSS, an equity linked savings scheme. Quite often these ELSS schemes are there for tax savings. So you invest in these mutual funds, but there's a lock-in period. Lock-in period is that within that period, you cannot withdraw your money. Now, let's say they are promising you a return of 6 or 7%. Now, if the interest rate in the market rises, and you find that if you had the money with you today, it would have been possible for you to invest at 8%. But you really can't avail of this opportunity anymore because you exercised your right to invest earlier at 7% and you're locked in now. So that is interest rate risk. So investors who cannot exit the investment made at the lower rate suffer a loss in interest. See, you are invested at a lower rate. You can't get out of it. There is a better offer now. You can't avail of that. So that's the risk. When you invest, then at that point of time, you are making you're gambling that the interest rates will not rise. A very simple example, I think, will suffice. So this is a real thing. I'd gone to the bank, HDFC in this case. This was around 6 months back. And I had, I'm a retired person, some FDs had matured, and I wanted to invest it. And we've been seeing rising interest rates. And I figured that if the interest rates have gone as high as they could, it was, I think, with senior citizen benefit and everything, I was getting around a little more than 7%. So they said, what is the period for which you would like to invest? I said, I would like to invest for a period of at least 10 years. So the bank person there said, it's 10 years, and suppose the interest rate rises. I said, for me, it's more important to understand. Right now, I'm getting a fairly good rate. It's more than 7. It's more than it has been in the last so many years. The chances that interest rates will rise higher, according to me, are minimal. So I would rather lock in my investment at this interest rate, because then you're committed to give me this interest rate for the next 10 years, rather than hoping that interest rates will rise further. Now, once I've locked myself in, if after that the rate actually goes up, then I am a victim of interest rate risk. Luckily for me in this example, this actual true thing, the interest rates so far haven't gone beyond what they were when I invested. So that's just as an example of interest rate risk. Now, the other thing is inflation risk. See, inflation is something which is very real. It keeps happening. So inflation devalues the return. In this context, it is best to consider the real return on an investment. What is the real return? This is the interest rate offered on the investment less the rate of inflation. So if the inflation rate is, let's say, 5%, and the bank is giving you an interest rate of 6%, your real rate of return after adjusting for inflation is just 1%. Now imagine a situation where you are earning less than the rate of inflation. In that case, you are not actually earning anything. In real terms, you are making a loss. So this is another reason why you cannot be tied down with very low risk and low return investments. Because see, interest rate risk may or may not happen. Default may or may not happen. Market risk, will come to that, may or may not happen. But inflation, in our country, inflation has always been there ever since I can remember. It is a fact of life. There will be inflation. So whatever return you're getting, ultimately, this return that you get will be devalued by the inflation. The inflation results in a loss of purchasing power. So it's a very, very real thing. So this is what this basically means is that while planning, you have to consider that your return, the ultimate return that you get, the real return after netting inflation, is a positive number and a good positive number. Only then are you really increasing the money that you have. Okay, the next one is market risk. Now, the prices of stocks, bonds, mutual funds, and other investments may fluctuate because of the behavior of the investors in the market. So basically, see, stocks and bonds, their prices tend to move mainly based on the demand and supply of these instruments. Now, if supply is restricted, then it's only demand that really makes the difference. And at a given point of time, unless some fresh IPOs get into the market, the actual supply of shares in a share market is more or less stable. Now, given that, it is the demand which will ultimately decide the price. And demand depends on whether people really feel that they want to invest or not in a company. And that is basically ultimately a perception. See, there are crores of people who are investing in the market. The ultimate share price is basically the cumulative aggregation of the buy-sell orders made by all these crores of people. And each of them is guided by their own perceptions. So ultimately, it's not something which can be predicted. So share prices are going to, the demand for shares are going to go up and down depending on perceptions. And therefore, there is going to be volatility. And this volatility is the market risk that we are talking about. So every market economy is subject to business cycles. And during periods of recession, this is when the demand has dropped, share prices have gone down, economic growth is not doing well, people are not investing, there is unemployment, that sort of scene. It may be difficult to sell assets at a good price. So if you have, let's say, financial assets like shares particularly, or property for that matter, you will find that it is difficult to sell it. Now, property values also tend to fall as do the values of stocks. So you will get a buyer eventually. It's not that you won't get a buyer. You will get a buyer. You just won't get a buyer at the price that you want. So that is market risk. Next, we come to I'm just looking at this point again. Is being conservative, being a conservative investor, good enough? This is something which I touched upon. But let's just look at this a little, just once more. What is the goal of our investments? Essentially, I'd say it's to earn more than we invested and to make a real return, if you add that. And then how much risk are we willing to take? So in the case of a bank deposit, the interest amount is known. There's minimum risk. The only risk that the bank itself collapses. This is a very rare occurrence. Okay, so banks sometimes do get into trouble. We have the Yes Bank case. But ultimately, even there, it was bailed out. And banks are generally never allowed to fail by the government. There's too much of a systemic risk for that to be allowed. So it is reasonably safe investing in a bank. So there's minimal risk. Now, since the bank guarantees the return, the risk is minimal. Consequently, the returns are very low. So what can the bank guarantee? See, the bank cannot guarantee a very high return. Because if it sort of, gives you or tries to get you to place your deposits with it, and on the basis of proclamations of very high rates of interest, and it's unable to get that high rate of interest, then ultimately the bank will have to pay from its own sources, from right inside its capital ultimately, and that will result in a loss. So the only way the bank can actually, survive and remain profitable is by offering you a rate of interest which is low enough for it to pay you and then use that to earn money. So if it can get the money from you at, let's say, 6%, 7%, then they can lend it out at, say, about 10 or 11%. And the spread that they get, that let's say 4% spread, out of that they meet their expenses, all the various costs that they have, and they're at the end they're left with a reasonable amount of profit. Remember, in the case of a bank, a certain amount of money is going to go, is actually going to become a bad debt, because no matter how picky you get, no matter how good you are at risk management, a certain number of loans will go bad for reasons beyond the control of the borrower also. So bad times come, lots of loans go bad, banks also take a hit. So banks cannot afford to offer you a very high rate. So risk is minimal for you, but the trade-off is that you get a low return. Now, for long-term investments such as retirement plans, it is not enough to be safe. Safety has a cost, low returns. There can be a situation where the returns are lower than the rate of inflation. This will mean having a lower real rate of return. This is the point which I wanted to emphasize. The implication is that to meet your goals, you have to take some risk. Short-term investments, now these are made for a specific goal. The amount involved is also relatively small. The mode of investment is some form of recurring deposit at a bank or a systematic investment plan in a mutual fund. Now, since the amounts involved are small, it is possible to take a higher risk. Even if it results in a loss, such a loss will most probably be within the capacity of most investors. But the long-term investments, the ones which you're banking upon to meet some large goal, like a retirement goal, those decisions have to be made with caution, and those decisions will also have to be made considering the ultimate return that they will get you. So it's not enough to say that I'm just being conservative. You could actually harm yourself by being excessively conservative. That's the basic point I was trying to make. So having said that, I'll move on to the next part here. So let's look at these different asset classes. So what are these asset classes? First, of course, there are the liquid assets, something which can be encashed very easily. So it's easy to convert a liquid asset into cash. The easiest, of course, is cash. It's already cash. Bank deposits, saving, recurring, fixed deposits. These are as close to cash as you can get because you demand this money back from the bank, they'll give it to you. There may be a slight deduction in the case of a premature withdrawal of a recurring or a fixed deposit. But apart from that, there's no issue. You will get your money back. Insurance policies have a cash value. That is, when you surrender the insurance policy, they will give you the amount of money which, as per the cash value of the policy, based on how many premiums you've paid, the actual life of the term of the insurance policy, etc. But it's still liquid asset. Now, in the case of, let's say, cash, it's just a question of getting it immediately. You demand, you get it. In the case of fixed deposits, breaking it and getting it maybe one day at the most. In the case of an LIC policy, maybe it's about 2 to 3 days. Now, let's take the next part here. Now, similarly, liquid assets will also include shares, which can be sold immediately, probably the second or third day, you'll get the money in your bank account. Similarly, you will have mutual funds. These are all forms of liquid assets. And some financial assets would tend to be illiquid. For example, you have an investment in a provident fund. Now, you can't take that money out beyond a certain amount which you can get as a loan. Otherwise, that is locked in till you retire. A public provident fund is locked in for 15 years from the date it starts. In between, a certain amount you can withdraw, but that is much, much less than the entire corpus. 40%, not more than that. So, depending on how easy it is to convert that particular asset into cash, that is the level of liquidity which that particular asset enjoys. Now, you take personal possessions. Included in this category are automobiles and other personal belongings. This is an asset class by itself. So these items may have value, but are difficult to convert into cash. Or if at all they are convertible, it is going to take time. You want to sell one of these personal possessions, there is a market, but there is a certain lead time involved before you can actually convert. The other thing is these assets tend to depreciate. A car will depreciate. Most other belongings that you have will depreciate. Exception here is jewelry, which tends to appreciate with age. Some of them may have an antique value and appreciate for this reason. But anyway, my point here is this is also an asset class. Real estate, houses, flats, land, vacation properties are in this category. So in a stable economy, there is no recession or deflation, the values of these properties tend to appreciate. If prices are falling, and can you just think back to the news you've been reading recently and think of a country, very big country, which has been doing so well for so many years, and it is currently going through a period of deflation where prices are falling, property prices are falling. If you haven't got the answer yet, it's China, where you're seeing a huge, huge problem. And they have a case of falling prices, declining growth, and an economy which is not performing the way it used to till last year. Okay, so just an example. Now, however, they cannot be easily converted into cash as the sale has to be made by negotiating with different buyers at an individual level. Imagine the case of a flat. If you do want to sell it, even if you use a brokering, a broker, 99 acres or any of those, you'll find that it is difficult still to sell because you don't know when you'll find a buyer for your property. So these tend to be illiquid. These are not liquid at all. And there is no institutional mechanism available that can facilitate the sale. It's not like a share where you make a sell order and then, the whole, the system is there where it is sold immediately and the proceeds are given to you based on the price. Here, that you just don't have that liberty. Then you have investment assets. So these are for long-term financial needs. They can be of various types. Some of these are listed below. So provident funds, we mentioned this. These include provident funds maintained by the employer, public sector enterprises, or with the employees' provident fund organization, EPFO, for private sector enterprises, or the public provident fund, what we've just mentioned. Then you have, let's take this is simpler. You have the government securities. You have NSCs, KVPs, RBI bonds issued by the government. These are basically risk-free, low-return, fixed income instruments. Then there is gold. This is treated as a separate asset class. So it has the advantage of moving counter-cyclically to the stock market. What is counter-cyclically? Basically, that means that the price of gold tends to rise when the stock market prices tend to decline. So when share prices decline, investors get nervous, they pull their money out of shares and they prefer to put it into something like gold where they feel that their money will be secure. So essentially, it will move in the opposite direction to the stock market. And that's why it's called counter-cyclical, against the cycle. Again, gold can also be invested in through ETFs, exchange traded funds. So in this case, the investment is held not in physical gold, but in the form of a share, which is a claim to a definite amount of gold. You can buy these gold bonds. The gold bond itself is valued in terms of gold. And when it's sold at the price of gold prevailing on the date of sale. So you get all the benefits of gold without actually having physical possession of the gold. That's the advantage in the case of a ETF. Then you come to mutual funds, investments in shares and debt instruments of companies by asset management companies, which build up a corpus of capital by mobilizing funds from individual investors. We'll look into mutual funds in a little while. So these investments are subject to market risk, as are equities, but have the benefit of professional managers employed by the asset management companies. So mutual funds, most of you are aware of mutual funds. Most of you know that this is an avenue of investment available to you. We'll discuss the working of a mutual fund before we finish today's session. And then, of course, there are equities, shares of companies traded on the stock market, risky but liquid, definitely, always liquid. They can always be sold unless, of course, you manage some junk share or something of a company which is basically trying to cheat people. As long as you stay with known companies, there is no risk of not getting any money back. You will get something back. Whether you will get back the amount of your investment or not, that of course depends on how well you timed it. Or maybe, as some people say, there's no way of knowing. You can't really time it at all. Mutual funds, since they are essentially based on investments in shares themselves, are also subject to market risk. And even in a mutual fund, you really don't know whether you're going to get back the amount you invested or less. But you at least have the satisfaction of knowing that your money is going to be managed by a professional fund manager who knows more about the markets than you do. So these are some of the basic asset classes. Last point here is that it is also possible to, go for, apps like Fintu, which will basically help you to make your financial plan based on, they have a mechanized system. They take a lot of data and then they try to figure out what is best for a person with a certain amount of income from a certain age group, etc. So they take those factors, they put it into their particular system, and the algo works out exactly what sort of investments you can make. So see, they have all these features. Expenses optimization and goal analysis, retirement analysis, future cash flow projections, investment recommendations, risk management. So in today's world, it is possible to actually outsource this whole financial planning thing to to some sort of a specialized entity which you can easily access on the net. And provided it's trustworthy, it has a good market reputation, you can also try this. Idea here is just to tell you that there are alternatives available. One is, of course, to do the hard work yourself. But no matter where you go, having a basic understanding of how to set your goals and what the concept of risk is, why risk is something which you're required to take under all circumstances, and to have a certain proportion of liquid assets always in your portfolio. Just having an understanding of these things will help you to become a better planner and plan these things well for yourself. Now, if you do it well, what should you get out of it? So it'll help monitor cash flows, and it reduces unnecessary expenditure, enables maintenance of an optimum balance between income and expenses. So once you're very aware that you have these goals to meet, maybe there will be times when there won't be any other way but to cut on the expenses. If there are expenses which are not mandatory, which you can actually dispense with, then maybe there will be times when it will be better to actually dispense with these expenses and go for the saving. So in the process, it will help boost savings and it will create wealth. It will also help reduce your tax liability, because when you save and you save in schemes which have tax exemptions, you're going to benefit. You know, all the ATC schemes, life insurance, post office investments, ELSs in mutual funds, that sort of thing. And of course, if you're doing it properly, you will get the best return possible for your investment. And it will ultimately help you to achieve life goals, financially secures retirement life, and most important, it gives you a certain discipline. Once you're aware of these things, that these are my goals, this is the money that I have, these are the expenses which I will have in any case, this is the most that I can save, then how do I save this optimally? How do I do it in a way which will help me to be prepared for the future? And if I find that I'm not actually getting there, and no matter what I do, I won't get there, once I'm aware of this, then maybe I can think of different ways of hiking up my income. But the first step in any plan, of course, is to be aware of what you're up against. So I think the biggest benefit in this sort of planning is that it will confront you with the reality. And once you have that, then you're in a position to actually take corrective measures. That's the big thing here. And I've mentioned this, not for everyone. Lastly, it also ensures that a will is made. So if at all there are people here, some of you who feel that you need to leave behind a will for your heirs, those who will inherit your property, then estate planning is also something which you should be thinking about. Now, what are the options that you have? Let's look at the actual instruments. So I'll just run through this easily. Savings bank account, very simple. All of us have it. Money market funds. Now, these are funds which offer returns better than savings without compromising liquidity. So you can actually go find like a money market fund. All mutual funds have a money market fund. If you download the proper app, for example, I use a Fisdom app. So if you go for a Fisdom app, link it with your bank account, you will find that it will allow you access to a range of mutual funds, among them various money market funds. Now, what do? They take your money, they invest in bonds mostly or shares, and you can get your money back whenever you want. Generally, they will get you a better rate of return than a savings bank account. Now, they are basically a specialized form of mutual funds, and they invest in extremely short-term fixed income instruments oriented towards protecting your capital and then aim to maximize the returns. So it's a conservative fund. If it's investing only in short-term fixed income instruments, one thing you can be sure of is that your capital will be protected. Then they usually yield better returns than saving accounts, but lower than bank fixed deposits. So the idea is that those savings of yours, which you keep in a saving account, some of that can be kept in a money market fund. Then you have bank fixed deposits. So the minimum investment period here is normally 30 days. It's very good for a investment period of 6 to 12 months. Interest rates are generally not very good, but for short term, as an investment, safety, liquidity, all that, it's very good. Then for the long-term investment options, you have the post office savings schemes, POSS, low risk, no TDS, and they're popular because they typically yield a higher return than bank FDs. For retired individuals, there is a monthly income plan. Besides the low risk, the fact that there is no tax deducted at source in a POSS is amongst the key attractive features. The post office offers various schemes that include National Savings Certificates, National Savings Scheme, Kisan Vikas Patra, the MIS, Monthly Income Scheme, and the Recurring Deposit Scheme. And then you have the Public Provident Fund, or PPF. So what does this give you? An 11% post-tax return, effective pre-tax rate of 15.7%. I'm sorry, these are a little outdated now. So this is now closer to 7%. A tax rebate, this is the same, deduction of 20% of the amount invested from your tax liability for the year, subject to a maximum of rupees 150,000 for a tax rebate. So basically, you can invest up to 150,000 every year in a public provident fund. It's risk-free. The amount you get at the end of 15 years is also not taxed. So it is exempt at the time you invest. The interest is exempt, and at the end, the maturity amount is also exempt. What does it lack? It lacks liquidity. You can withdraw your investment made in year 1 only in year 7. Although there are some loan options. So if you can live with poor liquidity, you should invest as much as you can in the scheme before looking for other fixed income investments. See, whatever amount you're going to invest, a certain amount of that investment has to be in fixed income instruments so that there is a balance between the riskier investments you make and the more conservative investments you make. And among the conservative investments, there is nothing better than a public provident fund. So that's one. Then you have company fixed deposits. This is again something which you approach in the same way as a share, in the sense that it has to be a good company. Offers are not always there, but whenever it is there, you can think of this. But please don't confuse the FD here with the bank FD, in the sense that this is not minimal risk. The risk here is the same as the risk for the company as a whole. Because if the company doesn't do very well, then obviously there is going to be a problem. So investors should consciously select the companies they invest in. Quite a few small investors have lost their life savings by investing in FDs issued by companies that have run into problems later on. Then there are bonds and debentures. So these are again instruments issued by companies. For the company, this is a debt instrument. They are borrowing from the public, individual members of the public. It's like an FD. There is a certain, some of the companies' assets are, like charged to, let's say, to these bonds, in the sense that in case there is a problem in paying the bonds, these assets of the company can be sold to repay the investors. And so it's another option that is available with you. At times, this is going to offer you a return which is better than the fixed deposits which are on offer at the bank level. So, and then these can be sold in the secondary market. So that liquidity is definitely there. And then you come to mutual funds and equity shares. So what are the main, I'll be covering mutual funds in more detail. But basically, what are the two main points with a mutual fund? You avail the services of a professional money manager who manages the mutual fund. So hopefully this gentleman here has a better idea about investment and investing than you. Access a diversified portfolio despite making a limited investment. This, I think, is the big benefit. The money which is collected from all the various unit holders is then used to invest in a large number of companies. So essentially, that old saying, don't put your eggs in one basket. So here what is happening is that you try to use as many baskets as you can to put all these eggs in. All the money that he has, the the professional money manager, he sort of takes this and he spreads it across 20, 30 companies. So if one company does badly, it only affects a small part of the entire portfolio. So in that way, the risk is definitely less. As far as the return is concerned, my own personal experience has been that it is generally a little unpredictable in the short term. You can sometimes get a return which is better than the return you would get at the bank over a 1-2 year period or a 3-year period. But if you go for an investment of 5 years or more, then the chances are that you will actually get a return which is better than the bank. But there is no guarantee here. Now, equity shares, the maximum returns always come over the long term. And you have to think in terms of 5 years or more. Anything less than that will probably be a little risky. Now, there are two ways in which you can invest: through the secondary market by buying shares that are listed on the stock exchanges, through the primary market, that is by applying for shares that are offered to the public. Effectively speaking, the actual experience of doing this is the same. You will be doing it through a trading account and a demat account that you will maintain. So most of the bigger players, HDFC, Axis, ICICI, they all offer you these services. You get a trading account, and if you use it cautiously and are a little, let's say, you do a bit of research, don't get greedy about it, don't get moved by trending stocks and things like that, the chances are that if you keep it for a 5-year period or more, you are going to do better with equity shares. So with that, that takes care of my overview so far. What I want to now sort of take you through is a little more about insurance, mutual funds, and equity investments, because I haven't really talked about insurance with you. Though we mentioned mutual funds and equity, Insurance is something we haven't. And since we all need insurance, I think it's essential that in any class on financial planning, we have to talk a little about what insurance is, what is the objective, and take it from there. So let's come to this part here. Insurance basics. Now, why do we take insurance? See, all of us, we have, the moment we get a job, soon after that, we take an insurance policy. It's the done thing. People will ask you about this. Insurance companies will approach you. It's something which you do. Why exactly do we take insurance? Is it an investment? Is it taken for protection? What is the basic purpose? See, in its purest form, the purpose is to provide for dependents in the event of the death of the income earner, who is the insured person. So the person who is insured, the guy who's earning money, this person takes an insurance policy basically to protect his dependents, people who are dependent on him for his income. Protect them against a situation where, because of death, there is no longer any income. And since there is no other income earner, or the other income earner, whatever income is coming in, it's not very substantial, the only way of ensuring that the dependents are able to maintain their standard of living is to go for insurance. This is the basic idea. Now, the main purpose is therefore the protection of the dependents. But what do we see in real life? What do we see? Insurance companies always market their insurance policies as good investment options. So most individuals think of insurance in terms of the investment benefits, without realizing that the insurance company charges for death benefit. See, the insurance company has to pay in case of the death of the insured person. So somebody who goes to the insurance company and thinks it's a good form of investment, please remember that if the person dies the day after purchasing the policy, the insurance company still has to pay the death benefit. And the insurance company protects itself from that eventuality by going in for something called mortality charges, which we'll see in a moment. The next thing we need to understand is there is a concept of a death benefit and a survival benefit in an insurance policy. So death benefit is the amount paid by the insurance company in the event of the death of the insured during the term of the policy. Who is it paid to? It's paid to the nominees. So when you make that insurance policy, you have to very clearly state who will be the nominee or nominees in case of death. So the death benefit is that. Now, apart from that, there's a survival benefit. The person actually making out the policy, the insured person, he survives the term of the policy. Let's say the term of the policy is for 15 years. Now, at the end of 15 years, this person is hale and hearty. He hasn't died. In that particular case, the insurance company is required to pay the amount to him. Now, that particular benefit is the survival benefit. Point here is that in most policies, the insurance company is required to take care of both the death benefit and the survival benefit. And because there is this death benefit involved, there is a certain amount of charges which are placed on the premium that you pay the insurance company. And this is known as a mortality charge. And what is the impact of this? It means that a certain amount, 1%, 2%, 3% of the premium, of each premium, is not going to go into investment. It is going to go into creating that fund from which this death benefit will be paid. That means no matter what the marketing guys from the insurance tell you, the fact is that if you give an insurance company 100 rupees as premium, that entire 100 rupees is not going in for investments. It's not being invested. A part of that is being retained by the insurance company to make sure that if a death benefit has to be paid, they don't pay out of their own pockets. And that is why insurance is not the best way to invest. It's the best way to protect, not invest. That's the point I'm trying to make here. Now, apart from the mortality charge, the insurance company also charges for the other expenses that it has. See, it has a huge organizational expenditure. It has distribution expenses. It has fund management charges. What are these fund management charges? The investable portion of the premium, of the premiums of all the people who are paying insurance premiums. That amount is taken and it's invested in the market. Now, to manage that, they also need a fund manager. Therefore, that part again, those are all expenses. And the insurance companies, they have their whole establishment. They maintain buildings, they maintain surveyors, they maintain development officers, agents, clerical staff, data entry operators, actuarial staff, all that is there. So all those persons have to be paid for. So they have a fairly large number of expenses, overhead costs, which are essential for them to provide us with the insurance benefit that they can provide. And all that has to be taken care of before they can actually invest. So a certain percentage of the premium is also being gets into paying these expenses. That's another point. Now, all these charges ultimately reduce the amount available with the insurance company for investment. Now, next thing I want to tell you is about basically two types of insurance policies. So one is term insurance. Remember, we'd mentioned term insurance earlier on when we were speaking about insurance policies. So in this type of policy, there is only a death benefit. There is no survival benefit at all. So the amount of the policy is paid to the nominees on the death of the insured. I'm not sure whether you're aware of this type of policy, but basically this is the policy which gives the greatest protection to dependents. So it does not have a survival benefit. The advantage is that the premiums are very low. See, the insurance company knows that in case the insured person doesn't die during the term of the policy, it doesn't have to return the money. Therefore, it can charge a low premium, offer a very big insured amount. What does the insured person get? See, the insured person gets the comfort of knowing that in the event of his not being around and the income to his family stops, in that eventuality, this big insurance payout will take care of the needs of the family. So for that, the person is willing to pay for this particular. So it can be taken out in crores, 1 crore, 2 crores, 3 crores, like that. Something which will never happen with the other type of insurance policy, which we'll discuss, because you will not be able to afford it. Now look at this. So for a 25-year-old, a rupees 1 crore policy is available for less than rupees 10,000 annually. This is a figure which I'm taking on the higher side. I checked up yesterday just to be sure that this is correct. And yes, this is the case. So this means basically that a person starting off early can take a term insurance policy and he can have a substantial protection for dependents. And if you're thinking about what do I do for the investment part, you can take the amount of money that you save, as against the premium you'll pay for the other type of policy, which is known as endowment policy, and use that for investment. Instead of investing in an endowment policy, you invest in a term insurance policy. And whatever amount you would have paid here, difference in the premiums, take that amount and use that to invest in a proper investment instrument. A place where like an equity, a mutual fund, where a death benefit is not involved. They don't charge you for that. They'll take the entire money that you have, just take a small deduction for expenses. And then after that, the entire money that you've paid them will be available for investments. So the whole idea is go for a term insurance for protection, take the money that you save, use that for investment. Now, if that doesn't convince you and you still want to go for a typical insurance policy, then the one you want to buy is a endowment policy. And this type of policy, there is a death benefit and a survival benefit. But the amount of policy is paid to the nominees on the death of the insured, fine. What is wrong with this policy is that the premiums are very, very high. Because the insurance company knows that in any case I have to pay. If the person dies, then I pay. If the person lives, even then I have to pay. And I have to pay with bonuses. So the result of that is they keep the premiums very high. So if you were to try to actually get a 1 crore policy, an endowment policy, you'd end up paying 1 lakh in premium or more. And the premiums are so ridiculously high that there is no point in actually trying to figure out what you will get. I remember still pay about 22,000 rupees annually for a 5 lakh policy. 5 lakhs, that's all. So basically, endowment policies should never be used as for protection. You can't do that. If you're using it for investment, remember, since there is a death benefit, there will be a mortality charge, which means that from the premium that you pay, a certain deduction is going to be made before an amount will be available for investment. So that's the basic thing about this. But the marketing for these policies, if you go to any website, you'll see they are presented as savings plans. But it's not the best saving plan. And they are generally linked to the stock markets. That's what you'll find. And the investable amount is invested in different securities, equity shares or debt instruments like bonds. You can actually decide the proportion, how much you want them to invest for you in equity, how much you want them to invest in debt. You can decide all that. You feel terribly empowered, at the end of it all. But it is not worth it because basically of the mortality charges. So that's one point which I wanted to make here about insurance. Another thing which I just want to explain to you is about mutual funds. So what are the advantages here, or what actually happens? So let's say there are investors, you're one of them. You pool your money with a fund. You get this fund manager. He takes the money from all these investors. He invests in securities. What are these securities? They could be bonds, they could be shares of companies. Okay, nothing fancy, nothing which you can't do on your own. So, but this guy is supposed to know more because of his professional ability. So he invests it here. And what he gets is, he gets returns. And these returns, after some deductions, are passed back to you. So this is how it actually functions. It's affordable, starts from rupees 500. But typically, possibly you'll start with 5,000 unless it's an SIP or something. There is professional management. Remember the fund manager. He's a professional. There is diversification, choice of schemes, hundreds of MF options are available. Sometimes this becomes a disadvantage. Though I presented it as an advantage, but in a manner of speaking, this can sometimes become a disadvantage because there are so many schemes, so many different choices, so many different flavors to choose from that it's actually tough. Liquidity, you can get back the money in transaction plus 2. That means the day you initiate the transaction for getting the money back, you'll get it back in 2 days from that day. There are tax benefits. Some of them have tax benefits, some don't. So those which do will give you a that same benefit which any other option under ATC does. Like, for example, we said PPF gives you a 20% benefit, so does this. A well-regulated and low cost, around 2% per annum. And transparency, you can see the performance every day. It's reflected in the net asset values of the funds which are displayed. And you can buy and sell whenever you want. How does the mutual fund actually work? There is a sponsor, the business owner. The sponsor basically, he sets up a trust. So there are trustees. These trustees are like a board of directors. And then they set up the asset management company. So between the sponsor and the AMC, there is this trustee. Why a trustee? This trustee is supposed to be looking after the interests of the people who buy units in the fund, so that the money which actually gets collected in the AMC is not diverted by the business owner for his business. So to insulate the people, the investors from any sort of wrongdoing by the sponsor, you have these trustees in place. The trustee sets up the AMC, the asset management company, and the asset management company basically comes out with the different mutual fund schemes. And when we invest in these schemes, and it is the AMC which hires that fund manager. It is the fund manager who then invests. So the operational side of the mutual fund is actually looked after by the asset management company. And they have managers, and that's it. And then there is a depository, there's a registrar, there's a transfer agent, there's an auditor. These are all the different people involved to make sure that this thing works. Now, SEBI has prepared a 3-tier structure for mutual funds in India. They all operate in India under SEBI guidelines. They are the sponsors, like I said. They are the persons who will conceptualize the idea of starting a mutual fund business. Before they can act further, they approach SEBI for registration of the business. Sponsors of the mutual fund forms a trust. The trust has a board of trustees, like a board of directors, and it's their responsibility to ensure that the mutual fund operates as per the regulations of SEBI. But the members may not be engaged in the day-to-day operations of the mutual fund. Who does that part? The asset management company. So the asset management company is a legal structure formed under the Companies Act. And then here's an example. We take Tata Mutual Fund. They are the sponsors. Okay. It's Tata Mutual Fund, Tata Investment Corporation Limited, another Tata concern. They are the sponsors. They set up Tata Trustee Company Private Limited. And then Tata Trustee Company Private Limited sets up Tata AMC Limited. And then the AMC manages the Tata Mutual Fund. Similarly, you have ICICI Prudential. So this is a joint venture between ICICI Bank and Prudential Private Limited Company of the UK. They float this trustee, the ICICI Prudential Trust Limited, which in turn comes out with the AMC, ICICI Prudential, AMC Limited. So just to give you an idea, 2 big mutual funds here. This is the way it actually works. So when you put money in a mutual fund, essentially, these are the different layers of protection that you have. You have a good fund manager here. You have diversification. You have these trustees ensuring that all rules of SEBI are followed, the guidelines are followed. The AMC or the sponsor is not cutting any corners here. They're making sure that you get a good deal. This is the idea here. And then let's have a look at the disadvantages. The disadvantages basically are, it's difficult to find a proper, to identify the fund that you want, because there are too many. There's so many different types of mutual funds. It's not easy to decide in which to invest. It's difficult to evaluate the performance of a mutual fund also. Now, how do you evaluate the performance, basically you're looking at the NAV, the net asset value. That is something which is displayed every day. You compare the price at which the units were bought at a particular date in the past with the NAV today and calculate the growth rate. Problem is, see, when you go for the investment, they will be giving you the rates of growth that the scheme has enjoyed in the past. So they may say it has a 23% growth, but the beginning and end points make all the difference. Over a given year, if you look at the NAVs, if you cherry pick the good numbers, when you start at a point when the NAV was really low, and then come to a point where the NAV is very high, which is the case in some years, you will get a fantastic return. And then in other years, it may not be so good. So it all depends. Then I'm giving you here this slide to show you the performance of different funds. So everything in red here means that the change over the period December 19 to June 20, all these funds actually did not do so well. I've deliberately picked this. This was, as you would have guessed, the period when COVID hit the economy. As a result of that, all the companies in which these different funds had invested, their businesses were affected. Demand in the share market plummeted. And the result was that they all lost. In the next 6 months, you can see that, except for SBI Mutual Fund, which has managed to show a growth of 3.33%, and Axis Mutual, which under circumstances has a fantastic growth of 9.32%. Everyone else here has basically shown a percentage loss. So minus 6.88% for HDFC, minus 9.74 for ICICI, etc. And Franklin Templeton, minus 36.90. One thing to remember in a mutual fund is when they take the money from the investor, they take these and they buy shares, they buy bonds, and these are the assets of the mutual fund. And these assets are managed, and so they are known as assets under management, AUM. So mutual funds invest in stock by buying shares. They will have investments in 40, 50 companies. These are all assets. They manage these assets, hence assets under management. Manage means buying, selling, and the whole process. If we obtain the current market price of each company's share, multiplied by the number of shares the MF has, we will get the total value of the assets it has. It's as simple as that. This is known as the AUM, or assets under management. Then the NAV, how is that calculated? This is the total asset value after netting the expenses and then dividing by the number of units. So you'll get the per unit value of the fund. It's calculated by the AMC at the end of every business day, and it's available. You can go and have a look at this. The value of all the securities in the portfolio is calculated daily. From this, all expenses are deducted, and the resultant value divided by the number of units in the fund is the fund's NAV. So NAV is equal to total assets, including current assets, minus current liabilities, divided by the total number of mutual fund units. So I hope that gives you an idea about, exactly what these different funds are all about, and what a mutual fund is, what they do, what are the advantages, what are the disadvantages. I've at the end given you these two slides giving you the growth. These are all direct growth plans of different flexi cap funds. Flexi cap funds basically means that they invest across large caps, multi-caps, and small caps. So just read that as large companies, small companies, medium-sized companies, and they tend to keep changing the proportion of investment in these funds depending on the prospects as decided by the fund manager. So you can look at these rates of growth. You can see the turnover ratio, how frequently there have been changes, and the CRISIL rank, and you have the number of stocks in the portfolio. So this is interesting. You can see that none of them here, the lowest is 36 for the JM Flexi Cap Fund. Otherwise, every other AMC here has investments in more companies, more than 36 companies. So there is a large degree of diversification. This is the point which you are trying to make. And here you have some large cap funds. The AUM and NAV are given. DSP top 100 equity for that particular period was ranked as number 1. It had assets under management of 2,654.86 crores. You see they're fairly big figures. And it had an NAV of 307.894. That means if you wanted to invest in the fund, each unit would have cost you 307, say about 308 rupees. Now, what are the expenses that a mutual fund has? So, the actual establishment costs of the mutual fund related to the employees that it has, the fund manager charges, and then all the other administrative expenses in actually buying and selling shares. So you have to have a registrar. There are expenses there when shares are transferred from one company to another. Like once again, there is a expense there. So there are various expenses, and these expenses come out of the earnings that the fund makes. Now, how much can they charge? That is fixed by SEBI. So a 1.5% expense ratio means that the AMC charges 1.50 for every rupees 100 in assets under management. So that is the amount they charge for this. It can be up to 2.5% for equity mutual funds and 2.25% for debt mutual funds. So SEBI has laid a cap that in the case of funds which are equity mutual funds, like the ones we just saw in the last 2 slides, flexi cap, mid cap, that sort of fund, for them, they are allowed to charge up to 2.25% of the assets under management as expenses. They may not actually charge that much, but that is the ceiling, 2.5. And for the debt mutual funds, it's 2.25. Why does equity have more? Because equity investment is traditionally a more aggressive form of investment. So it's expected that the turnover in the case of equity will be higher. Number of times the buy-sell, actions take place will be higher in the case of a equity mutual fund as compared with a debt mutual fund. Therefore, the expenses will be more. Therefore, they're allowed a higher cap of 2.5%. What does it include? Management fees paid by the AMC to fund managers, transfer agents, custodians, legal fees, and marketing and distribution expenses. The daily net asset values of a fund scheme are reported after deducting such expenses, though the expense ratio is disclosed only once every 6 months. So I think with that, you at least understand, you have a minimal understanding of how mutual funds actually operate, who sponsors them, what is the concept of a trustee, what is expense ratio, what is AUM, what is NAV. You should just have an idea of this. Once you get into the business of actually investing, you'll feel more comfortable with this knowledge. Equities basics here. So let's look at what it means first. So equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. That sounds terribly complicated. What the definition is trying to tell you is that for equity shareholders, basically anybody who owns a share of the company, what happens there is that in case the company is liquidated, wound up, closed down, then in that case, equity shareholders are only going to get their money back if something is left after selling the assets and paying off the creditors. After the creditors are the bankers and everybody else, the bondholders, after they have been paid off, if something is left, that will be distributed among the shareholders in proportion to the shares that they hold. So essentially, a person with equity, after all, remember, he's a small owner of the company to the extent of his shares. So his risk is the highest. Each individual shareholder owns the company to the extent of the number of shares she has, hence they are known as equity shares. Shares will not be redeemed by the company, remember this. Shares can only be sold in the secondary market. That is to a new investor who is willing to invest at a time when you want to sell. When you basically buy equity in the share market, you're the new investor. Somebody who had already bought the share earlier on, has presumably made a profit, now wants to exit, quit the investment, that person will sell to you. So that's that. Now, a last slide on classifying stocks. So blue chip stocks of well-established companies, considered safe. Such companies have a history of stable earnings, dividend payments, etc. For example, you think of Britannia, you think of some of the major Hindustan Lever, big FMCG companies. So these would basically be companies with a good track record. They've been around for a long time. Lots of data is available about these companies. Income stocks. So these pay higher than average dividends. So companies with steady, predictable source of income, like utility companies. An example here would be like something like electricity company or a gas company, companies which have steady source of earnings based on what they supply. So if a company is supplying power, they are getting a steady revenue. So the better companies will offer good dividends. So those are known as income stocks. Growth stocks are companies which have the potential to give the highest growth. Think of our lecture at the beginning of the session on dividends and the retention ratio and all that. Key factors are an expanding product line, quality merchandise, a good R&D department. These companies may not actually be paying good dividends. Remember, when we looked at the companies which retain the entire profits, we found that there are some very good companies which prefer to retain. Apollo, for example, Apollo Tyres. Because they have this issue. They are expanding their product line. They have quality merchandise, and they have to keep building up their product variety so as to increase their market share. And then there are cyclical stocks. These stocks move with the economy. So automobiles, steel, cement, heavy industries, banks, they do well when there is economic growth, and they are passive when there is a downturn. So when you invest, try to see which particular type of company you're investing in. So that will give you an idea about what to expect. That is why I had done this exercise. And then you have defensive stocks, remain stable during declines in the economy. And many of the blue chip stocks will actually fit into this particular category. So that actually gives us a good idea about companies and what to expect from equity. If you want to conduct an analysis at your own level into this, then these are the factors which you need to consider. So EPS, earnings per share, this is basically profit after tax divided by number of shares. So you know the profit after tax per share. Price earnings ratio, price per share divided by this, the EPS, price earnings to growth ratio, dividend payout ratio, what we had discussed, the current yield, the annual dividend divided by the market price of the share, annualized holding period yield, total return divided by original investment, multiplied by 1 divided by number of years. It can be a parameter that will help you to decide when to sell a stock. And see, these things to be used will require a certain amount of knowledge on your part, a certain amount of practice before you can actually do it. For the moment, it is probably better to rely on good advice by reliable sites. Research the company a bit, get a feel for it, see what people are saying about it, and only then actually decide whether you want to invest or not. The NASDAQ in the USA, they have these, different parameters which are relevant. They look at a company in terms of the revenue, the sales growth over the years, the EPS, the return on equity, that is the net profit divided by shareholders' funds. We've discussed this in the past. They look at recommendations, see this part, look at reports of analysts. This is the part which you can do easily. Earnings surprises. Has the company outperformed the expectations? This is another thing. The market has certain expectations. The demand for the shares are based on these expectations. So has the company actually managed to outperform the forecast? The company itself will also make projections, and these can be found in their investor presentation. So are they doing better than their own forecast, or they aren't able to achieve what they forecast themselves? That again tells you a little about the company's management and other aspects of the company. Then the growth in its net profit, the earnings growth, the PG ratio, what is the growth in the EPS over the years? Over the years, that the earnings per share, how much exactly has it grown? Industry earnings, this is a comparative metric. How do the earnings of the company compare with the average for the industry as a whole? So what you see where does this company stand in terms of other companies in the same industry? So NASDAQ uses these. These are not relevant for us. So I've just put it in red. Just if you just want to look at it, it's there. Now here are some figures from one company here, Dr. Lal PathLabs, another very good company. So sales growth over the years, 15.82%, EPS growth, 25.25%, EPS, 33.93%, earnings per share, earnings growth, 23.57%, return on equity, 23.09%. So this is March 21. You look at the other figures here also, you generally find that return on equity is all above 20%. Now that alone tells you that here is a company which is consistently performing well for its shareholders. Now, if you invest in a company like this over a period, of 5 years or more, there's very, little chance that you will lose money. What you learn, no one really knows, but given that track record, the probability of getting a better return is good. That's the basic point I'm trying to make. If you do some of this, it will give you a good idea. And where do I get all these figures? You go to a site like moneycontrol.com. I've written it here for you. You go there, have a look at financials of different companies, take an Excel sheet, do a bit of work at your level. You will be more prepared to make that investment that you're thinking of than you were before you did this. Remember one thing always, never be satisfied with 1 year. Take 4 or 5 years. Money Control makes it easy. It always gives you, a number of years. So once you do that, you will find that you can make a reasonably good decision. So that sort of brings us to the end of, our financial planning section. And I sincerely hope that that was of some use to you. And we'll meet again on Sunday with the next part of this series. Thank you so much for listening to this, and see you on Sunday then.